On. Don't need the camera. Sharing a file. Looks good. Let's get started. All right, let's start with problem 24. And hopefully you didn't have much of a difficult time with this one. This is so simple, simply structured that if you basically just took your income and upped it 15%, that's what you needed. So if you went through all of this, so then you might get a little rounding error here. But let's just say you came up with a forecasted net income of 575. The story says that we'll be paying 60% initially, and we can add 230. So the difference, in other words, goes to retained earnings. So assets increase proportionally to sales. And I just left the debt where it was, added the equity to it, the 230 that we have up here. I added that. Well, what in the world? Why go through all that? I had the 230 and gave me total capital of 3230. I had assets of 3450. The external funding requirement for additional funds would be 220. All right, and the balancing item is debt. I could very quickly make this work just by take my debt and add to it 220, and all is well. All right. All right, the next part asking what the balancing item would be. It would be debt, and it would be in the amount of 220. The next part caps our debt at 1100. So many ways to do this. So this is one of them. I have assets again, 15% growth from 3,000 to 3,450. Debt is capped at 1,100. So you can see here I have to fund 450 in new assets, don't I? Okay, and obviously this this debt will not be sufficient, but it's part of the structure. So we'll run our debt up to 1,100 max, and that's just part of the story the problem gives you. Okay, and that leaves me short 350. Okay, we're asked to adjust our dividend. So if our earnings are 575, and we, in order to make this balance, must add 350 from earnings, then we readjust the dividend down to 225. So it gives us the 225 dividend. And so to make this balance, well, that's nice. To make this balance, we'll begin at 2230, and we will add the short amount, and that was 350. Oh, that's nice. Oh, I'm sorry. My fault. There we go. So we'll add 350 from current year's earnings, and now it works. So hopefully there wasn't much of an issue there. Numerous ways to do this. Let's go then to number 27. Okay, and I just have to caution you that it's wonderful to be using Excel, and I know you have skills that you can copy things across, and that's good. Except it would take me about 5 minutes to rewrite this problem such that this would no longer be copyable. And the reason being is that each of these years, we required the full amount of debt up to its limit. I could very easily rewrite this question such that maybe after year 218, you would no longer need the full amount of debt that's available. Okay, so we should really do this in steps. So from what we're given, we know that we have assets in place of 1,200, and it will generate $1.75 for every dollar of assets in place. All right, and let's get that. Okay, depreciation is equal to the 53. That was part of the story. Depreciation. Sorry, fixed costs are fixed in this range of revenues. So variable costs, pretty straightforward. All right. Then depreciation. The story says equal to 10% times the sum of beginning net fixed assets plus investment. You see, I could just vary the investment every year, couldn't I? And I would completely change this problem. But in this case, we just have to simply type it in because it won't change. All right, and then EBIT, pretty straightforward. This one minus this one minus this one, and away we go. All right, interest. The story says it's just based on beginning of the period debt, which makes a large amount of sense. If I were to set this up, not to solve a particular problem, but to conduct a full analysis, everything that could possibly change, I would have it parameterized at the top of the problem. So I'd have the interest rate up there, I'd have the tax rate up there, I would have the total asset turnover, which is now 1.75. I would have that up there. And so that way we could flex all of these numbers and just watch what happens without having to redo a thing. So we'll take 11.8% times our beginning debt. And so we have taxable earnings of what we have here, and that's good. And then we'll take some tax at a sky high rate. Hopefully we'll never see again, but I don't know. Some people like to spend other people's money. And here we go. All right, so now we have 143.21 in income. And your text calls operating cash flow the sum of net income plus depreciation. All right, well, let's just take a little vision of the top section of the statement of cash flows. Not this thing, but the statement of cash flows. And you'll see it starts out net income plus depreciation. And the top part is called cash flow from operations or operating cash flow. Okay, so you start out just what these, what the authors are suggesting. You start out with net income plus depreciation, but then you go through all of your changes in working capital. So you subtract your any additional receivables, you subtract any additional inventory, you would add to this value any additional payables, any additional accrual, and so on. Anyway, what I'm saying is this number is operating cash flows, income plus depreciation, only if there are no working capital changes involved. So we'll follow the script. This is what your book did. So it took the net income plus the depreciation. All right. Now what I did differently, you know what I have here, it says similar to 210. The reason it's not the same is because 2910 table started with where you left off here. operating cash flow. And I'd rather do these separately, just as you would on the statement of cash flows. So that's not much of an issue. We can do it. We'll take our net income plus our, oops, sorry. And we'll take our depreciation now that we have it. All right, and at this time, I'll add everything here. Oh, don't get the year. That wouldn't help much with it. All right, so these are my sources. What are my uses? Okay, so let's come up here. Okay, we have to do the top part here. And we know that we take the beginning net fixed and add to it the investment less the depreciation. So if you think about it, what are your net fixed? Your net fixed are what? Gross or total fixed assets minus accumulated depreciation. So what have you done with these numbers? You've added 200 to the gross fixed, but you've also added what was it up here? 100 to the cumulative depreciation. So the net outcome is only 50, is only 100 more, isn't it? So it's 200 minus 100. Okay, then we'll follow the story. The story says that working capital remains a constant proportion of net fixed assets. So we're going to say equals this one divided by this one. So this ratio stays the same times the current year's net fixed. No problem. So add these together. All right. Now I have a basis for calculating my debt ceiling, but let's see if we need it. So we are increasing our working capital by 50. We have an investment, and this is a given. You see, I could completely change this problem by giving a, say, decreasing schedule of investments. I could do any number of things to make this much more interesting. Okay, a dividend. Okay, we know we're going to be paying out 2/3. I'm just following the story times net income. Right. So I have uses, projected uses of 345.47. I have so far sources, not including debt, equal to 243, and we'll just see what happens here. So I'm short 102.26. Okay, so now I look down and see how much of that can I meet using new debt. Okay, so we'll be capping our debt at 20% of assets. Okay, so let's come back up here. Now that we have this number, do I need it all? And I'll say equals 270 minus 240. Did I need it all? And the answer is yes. I'm still 72.26 short. So not only do I need all the debt that's available, I need to issue new equity at 72.26. So now look what we're doing here. This company is doing. There's a nice pipeline between the company and its investors. And what is flowing? Well, they're paying out $95.50 in a dividend. And they're taking back new equity in 72.26. I think a reasonable question would be, why didn't we just adjust this dividend so that I don't need to issue new equity? There's all kinds of issues here you have to take into account. And one might be is, what type of investor do you have? What's the purpose of your stock in that investor's portfolio? Well, what if your stock is, and you can see with the 2/3 of earnings as dividends, this is an income stock for investors. Right? So if they pay out less, than what investors expect, that would send a bad signal, and they would likely find a price decrease. The value of their stock would come down. Right? So we're going to work with the assumption that they need to maintain this dividend because they're viewed as an income stock. Right? So because of that, we will have to issue new stock in the amount of 72.26. So what does that do to the book equity account? Well, it says that it's equal to where it started plus our addition from earnings, and we will be adding 1/3 of our earnings. Okay, and now I think somewhere along the line you probably would say, well, don't I need parentheses here? And to be perfectly safe, you probably could put them on there, except that Excel goes from left to right in its order of operations. So it's just going to take the third first, then it's going to do the multiplication. So this works just quite well. Right? And then we'll be adding to that our addition to retained earnings. I'm sorry, our new equity. And now we will balance very nicely. Okay, so we have to investigate each year. We have to analyze each year if we need the full amount of debt. Now, I know some of you just took this and whoop, copied it across, took this, copied it across. Sound effects are free, by the way. Just copy these across. You can't really do that. So now I have the investments in place for 218. We can continue the process. So actually, these first two are very copyable. Oh, BTW, watch what happens here. I had a couple of people do this, and I just put it equal to this one. And what if I just said it's equal to 53, which we know is true, and there's nothing wrong with this entering 53. But watch what happens when I copy these across. I'm just trying to show you this. You maybe have experienced this before. See what Excel does? It tries to outthink you. So anytime you have a constant embedded within a group of equations that you might be copying, just put the equal sign in front of it, and then Excel will hold that constant because it's gone from a literal now to an equation. Okay, and then our variable costs, that's easy to do. Okay, and then depreciation is very copyable at this point. Yep, and all these are copyable. We could do it for 1 year. All right. Now we have to analyze what amount of external funding will be required. So these two are the same. Okay, and now the sum says that we have 276.3 in funds in sources. Oh yeah, I was trying to say, how did we go down so far? Well, you can see depreciation went up 10, and but earnings went up a little over. Yeah, so we're all right. I think it's good. All right, and then let's come down here, get our assets in place, so we can do the next part. So this is copyable. This should be copyable. In fact, I copied this whole thing. I guess I could have, for 1 year at least. And you can always do a quality check here. So what's this doing? Previous 200 minus, yep, depreciation is right. And this, of course, is a 50% ratio. It looks good. All right, so let's set up our uses, which we can now, this is totally copyable. Okay, and our shortage at this point is 79. All right, and assets have gone up, so debt would go up also because we're keeping debt at 20% of that number. So therefore, if the assets go up, your debt cap goes up. But I think we can see it will not be sufficient. So we're going to go up, what, 27 here? And we need a total of 79 will not make it, so we will take the full amount. And now we're short 52, all right? And now these equations are copyable. See what I'm saying? It's just not automatic that you'll use every bit of this debt that's available. And you'll see by the time we get to 2021, we almost don't need it. We just need just a small amount of it. So let's, I'm sorry, we'll still need it, but you can see that if we went to 2022 or 2023, that that amount of the debt which we will be issuing will continue to decline or even go away. Okay, so let's follow along. We can do the script. Let's do our assets in place. Let's see. We need our depreciation first. So we have assets in place this year. So this all is copyable because it's all based on the previous year. And let's see how we did here. So it's 10% of beginning net fixed, yes, plus the 200. We're doing great. Okay, so continuing our process, these two are copyable. All right, these are not copyable. We need to do our assets in place for 219. And now that I have depreciation, oh wait, am I doing this right? Yeah. Now that I have depreciation, this is fully copyable. Yep, that's good. All right, so that makes these copyable. Back to all these. Okay, so our shortage is 58.96. We will now use all the debt that's available, and let's set that up. Okay, 32, so we're getting what, 3 plus 21, about 24, and we need 58, so yes, we will use all of it. So let's copy that across. But you see how this is coming down? It's going to be less and less, and you could get to the point where you don't use any of it. Right? So these are now copyable. And we balance very nicely. So let's keep going. Assets are in place, so we can do one more year of income statements. All right, and then these top two come from that income statement that we just completed. All right, and then now we need to complete the excuse me, we need to complete the upper half of the balance sheet, and these will be copyable. All right, and make sure this looks like it did what it's supposed to. It looks like it's doing just what it's supposed to. Very good. All right, now we can calculate our debt. Like, why do it? This is copyable. All right, so we'll go up, what, 22 in available debt funding. What's our shortage? Our shortage is, oh, I haven't done that yet. Okay, now we have the balance sheet, the assets in place. We can do this. All right, we're short 40.50. We have available in debt, looks like 43 minus 21, 22. That will not be enough. We'll use it all. So let's continue to use all the debt. And our shortage is now, we got it down to 18, don't we? And so these are now copyable. Yes, well, what I'm trying to get at, obviously, because of the way this problem was structured, I could have copied a whole bunch of things all the way across. But that's not a necessary outcome. It could be that there's a change. That there's a change in here, you know, of the, if I had a different investment schedule or other things could change and therefore I may not need all that debt. So you have to check it each time to see what amount do I need. All right, that looks good. All right, so we got one more year and then we're done. So let's copy the income statement. This is copyable since we have the assets in place for 2020. Let's do 2021. And okay, and let's do our left side of the balance sheet. Okay. Now we're able to calculate accurately our expected uses. Actually, you know what? We can do our sources first. Let's do these sources first. Okay. And then let's do our uses. Okay. We are short 2388, and let's cap the debt at 20% of assets. That will provide 20, won't it? So we're getting there. We're 20 against 2388. So except for rounding. All right. So that tells me we will be using all of it. So that'll become our source. And we're now down to, and if you'd like to, just to make sure you're right on the button, have it exactly correct. You don't need that many, but say. So this is our external funding for the last period. And then, yeah. So I was telling some people who I spoke to during my office hours that, you check your numbers against this one, because if this one's right, I mean, you would have to be the unluckiest person on the planet to have anything back here wrong, because this accumulates, doesn't it? Right? So if I had an error back here, like just say I accidentally invested 100. How about that? Oh, okay, yeah, it fixed itself, didn't it? Oh, I guess I'm wrong about that. So I guess you could have this right and have an error back here. All right. Well, anyway, so the problem asked you the question asked us to create statements similar to 29, 9, 10, and 11. We did that. And then it says generate a full set of financial statements for 2017. And we basically did that. There's your income statement. And here is your balance sheet. So we've done all that. Looks like we're done to me. So I'll pause, take a breath, and see what questions you might have. All right. Well, seeing none, what I'd like you to do, excuse me, I'd like you to do now is go to the Canvas, and on Canvas, you will find a file in the corporate valuation group called, let me see what the name of that file is. I have it open. EVA examples. So if you would please open that file. So download it and open it. We are going to work with it. So anyway, there you go. All right, let's assume we were able to open that file. And I believe that's going to require that would, unless you're already on Canvas, that would require a push, wouldn't it? So that's why I'll give you a little extra time to do that. All right, well, this is what it looks like. And we've had some competitions where for students or our finance majors will compete with other schools and try to evaluate a company. And I think that we generally, one of the competitions we become involved with, they actually evaluate a Wisconsin-based company, or at least a company with a strong presence in Wisconsin. And interestingly enough, one of the sources of information for conducting an analysis of the company has been provided generously by an association which works with the EVA methodology. EVA stands for Economic Value Added. Okay? And their database has just a wealth of performance numbers from all the publicly traded companies, at least, and others, and they are valuable aids in evaluating the performance of a company, right? But no, when EVA first came, economic value added first came, excuse me, there were a number of traditionalists who argued there's nothing new here. So I'm going to show you something here. Let's set an R value here of 20%. All right. And let's say I were doing an NPV. All right. And so I would start here with a year. So year 0, 1, 2, and year 3. All right, and the cash flows would be minus 100, and then the 3 given in the EVA format. All right, so I'll let you catch up. So you have this kind of set up this way. You wouldn't even have to do this, actually. You could just use the numbers over here, but this is what it would look like if we were doing an NPV. All right, so now let's do an NPV. All right, so we want what? The present value of these 3 numbers and plus the initial investment expressed as a negative number. So we'll say equals NPV, cost of capital. And then, of course, we'll take our cash flows 1 through N and add back to that our initial investment. And let's just see, why did that get so big? I did not know that. Oops, went the wrong way. Okay, let's use the comma format. Yeah. So anyway, what happened here is that this problem came out of your book, and you know, I could goal seek or solver, whatever I want to do to make this number come out such that this number is 0. We could do that, make it come out. It's supposed to come out 0 is what it amounts to. All right. So this is a 0 NPV project, and it rounds off to a penny. So what? All right. Now let's do the same problem, only using an EVA methodology. Okay. So in the EVA methodology, you don't have a year 0 as a separate column or as a separate entity. What you have, though, is they show the beginning capital. So you have the cash flows. Those are no different. So these three are exactly these three. Okay. Instead of showing your initial capital as a minus number, we show it as a positive number, and we call it beginning capital. So we begin this investment with $100 invested, and then at the end of the first year, we have a value called the ending capital. Well, what's the ending capital? The ending capital, and again, what's any asset worth, regardless of, it could be precious stones, it can be farmland, it can be anything. It could be financial securities. What's the value of any of these? It's the present value of all future expected cash flows discounted at a rate appropriate for the riskiness of the investment. Yeah. So EVA actually uses a theoretically sound method to find this ending cap. It's the present value of these remaining cash flows. So we're going to say equals NPV, and we'll take our 20% R, and you might want to, you really don't need to. Okay, yeah. And take your remaining two cash flows. All right. And so this project is worth 120.01. All right. So how much value did this beginning capital lose throughout year one? Well, this is an interesting problem because it didn't lose value, it gained value. So I always compare this this project to anyone who has purchased a Porsche in the last 4 or 5 years, because you'll find that your Porsche is probably worth more now than it was when you bought it. So this asset has actually appreciated in value. So when it says economic depreciation, how much value did you lose here? You didn't lose any, but follow the script. We'll take the beginning cap and we will subtract the ending cap. Okay, so we actually have a negative depreciation here because this gain value. Okay, let's do our first definition, economic income. Economic income.
I'm sorry, Professor Ogden. Could you show me the formula for C4 again, please?
C4. Yes, it's the present value of the two remaining cash flows. I mean, two in the sense for this problem, for any remaining cash flows. So I'll do NPV, and I use the R that we're using throughout the problem, 20%, and then just take, highlight these. Are you okay with that?
Yes, thank you.
Yeah, that's fine. No, please ask questions. Slow me down if I go too fast. This is far more easy for me than riding a bike, all right? Because, while this being cooped up has probably in some ways helped my brain, because I've been studying and doing things like this so much, but physically it's been a disaster. And I got on my bike the other day and I might as well start life all over again. It was just I'm not there, but here, this part's easy for me. All right, so economic income is equal to cash flow less any economic depreciation. Now, interestingly enough, if you went back to chapter 6 when we estimated cash flows, it's not a whole lot different. It's done differently, but many of the elements that we're doing here are there. All right. So economic income, let's do it. We had a cash flow of 0. We had a capital appreciation of $20. So we'll subtract the negative depreciation. And we get 2001. Okay, so our next little thing is called the ROI. That's return on investment. And in our next, when we get to valuing not just projects, but whole companies, we're also going to call this return on invested capital. Thing. And this equals econ income divided by beginning cap. Okay, so we'll come over here. I'll give you a moment to catch up here. But this will equal our economic income divided by our beginning cap. And so what has happened here? Paying $100 for this investment, the first year has exactly earned the cost of capital. It's earned the cost of capital, within rounding. It's earned the cost of capital. Okay, and EVA is any amount that you earn above the cost of capital. So that's why it's called economic value added. Added to what? So economic value beyond the cost of capital. So economic value added is the value you add beyond the cost of capital. Well, in this case, we didn't add any. Let's go through the calculation, and the calculation would look like this. The EVA would equal your ROI. Oh, I can't do that. That's illegal. Let's keep parentheses here, sorry. ROI, okay, minus your WACC, or your cost of capital. In this case, it's the WACC, times your beginning cap. And I do believe in the database that has this EVA material in it has a number called EVA margin, and this is how they calculate it. They take the company's return on investment, subtract its WACC, and multiply it by the beginning capital. Okay, and I think you'll see here pretty quickly that we're not going to be earning anything. So we're going to take our ROI minus our cost of capital, and we can lock that, I guess, if you want, times the beginning cap. So one thing they have that this format allows you to see pretty obviously, I believe at least, is that how do you create value? Okay. Well, you have to have a margin between your ROI and your WACC. Okay, that creates value. So what do? I can increase my ROI, I can reduce my cost of capital, or I could put in place, I could increase my assets in place that are earning this margin, couldn't I? Those are when some people call those the value drivers. That's what drives value. This margin and the beginning cap. Okay, so let's do the second year. Okay, the beginning cap for 1 year is the ending cap of the previous year. Okay, Right, now what's our ending cap here? It's the present value. We just have one cash flow left. This is a simple problem. I mean, one cash flow left, so let's do it. We'll take this cash flow and we will discount it back at 20%. So I don't know, what do you want to do here? 1 plus, just to show process correctly. So divided by 1 point, if you want to type in 1.2, it won't hurt a thing. Okay, so this is our ending cap. Now you can see this time our capital has lost value. So there will be a positive economic depreciation. Okay, and following the same procedure we did for year one, we'll take the cash flow and subtract the econ depreciation. All right, this is our economic income. Now, what's our ROI? Well, we earned $13 on beginning cap of 120. So let's try that. Did I get this right? No, it's my fault. My fault. I could see right away it wasn't right. Okay, sorry about that. You know, if I'd have been just smart enough to copy this equation, I'd have had it right. Okay, there we go. So anyway, I want to take the cash flow and subtract the economic depreciation. I grabbed the wrong cell. So I'll do it again just to make sure. So cash flow, and we will subtract the economic depreciation. That's your economic income. And then you can see that we're still earning 20%. And then one more year to go. Well, here we go. This method of finding the ending cap is, that's pretty straightforward. It's just the beginning cap is the ending cap from the previous. That's straightforward. Now, what's the ending cap? The present value of all future expected cash flows. Well, there are none. So this will come out 0. And then we'll set our economic depreciation. You know, we can just copy these. And away you go. All right. Now, what does the company do to create value? What's this method telling me that I didn't already know? Right. Well, what it will take to create value is that you would need higher cash flows, perhaps. Well, let's do a real simple one. And just to show you, what happens to my NPV over here if I can buy into this at, say, $80? Okay, just watch what happens. You can see that obviously I'm going to get aren't I going to get a positive 20? Because if I bought in at 100, it was 0. So if I buy in at $20 less, I should be able to realize a positive NPV of $20. Okay, let's come over here. So let's set this one to 80. You see, now you have an economic value added for the first year, don't you? And so these other 2 years, you will have none, of course. But you do have some. Now, what's the MVA? This is your market value added. Right? And that's the present value of, of the EVAs. Okay, so I only have one positive EVA here, so why don't we discount it back at 20%? So I would say equals this number divided by, and we're going to bring it back 1 year at 20%, 1 plus R. So my market value added will always, always, always equal the NPV if you're working just with projects. Now we will eventually begin working with companies. And that's what this whole unit is about, valuing a company, not just valuing one project, all right? And so you might make the argument, well, what did I learn here? If I just did an NPV, I know that the NPV is 20. Why did I go through all this to get 20 here? Well, the difference is that the NPV analysis gives you but one number, and that's the present value of the future expected cash flows less the investment cost. Well, over here, you actually get an EVA each year. And if this were, say, valuing the performance of an entire company, not just one project, we could find an EVA for every year. And what do I do with that? Well, we set up the bonuses for those in the C-suite, your CFO, your chief operating officer, your chief financial officer, your C-suite people. Their bonuses will depend upon financial performance of the company, or they will be based on, say, 8% of EVA. So this is what the people were preaching when they were selling this EVA methodology, that your executive compensation based upon a performance measure instead of just rewarding them with stock options. If it were based on a performance measure, they would strive to create high values of EVA because they would see the results of that as higher bonuses. So you can set their bonuses based upon some percentage of the EVA they've earned for the entire company. And so I technically have a number here every year. Now, this particular problem didn't give me a number every year. It gave me zeros for the last two. But so at least my executive compensation might be 2% of this number. So above your salary, of course. So executive compensation was one of the focuses for this EVA method. Okay, now let me show you another little added feature of this EVA. Okay, let's set a R over here of 10% for this problem. This is another example. All right, and let's begin just like we. Oh, you know what? Let's eliminate these. I'm sorry, we don't know. Well, those are right, but we just don't know them yet. Let me show you how to find those. Okay, so we're going to say the beginning cap is 12, and we will have economic depreciation, but let's also set up book depreciation. And we'll use straight line and a salvage of 0. So our book depreciation will equal our beginning cap minus 0. So our investment minus 0 divided by n, which is 3. So we have book depreciation and equal to $4 each year. Now let's compare that to economic depreciation. Okay, so let's start out. Here's our beginning cap. And let's do our ending cap. Okay, you know how to do it. Go ahead. It's the present value. So NPV at R and the remaining cash flows. That's where that $8 came from that I should not have included. All right, and then our economic depreciation, we'll take our book depreciation. I'm sorry, what am I talking about? We'll take our beginning cap and subtract our ending cap, and we get $4. The economic income, just like we did before, we'll take the cash flow and subtract the economic depreciation. $1.20. All right, now there's a little different method for calculating EVA, and I could show you mathematically that this is all the same as what we did above, but let me just show you how it works. There's something called a capital charge. The capital charge is the beginning capital, and let's be a little more specific, beginning of period cap times the WACC. Okay, and WACC is also your R, isn't it? All right. Now, I have a former student who actually introduced me to EVA. I'd never heard of it. And he was working for a company that was a straightforward EVA shop. And so he sent me a great deal of information about how it works, and I studied it, and I introduced it into my classes many, many years ago. But he used to come and teach EVA for me when I didn't know what it was about. And even if he did it today, it'd be much better than I do it. But I took him out for supper when we were done. We went down to Manny's, in the south part of the town. And he walks in and he's looking all over. And looking at the ceilings, the walls, and I mean, if he's out of Minneapolis, so Manny's is a very fine restaurant, but there's some pretty equivalent ones in Minneapolis. So I'm thinking, oh, he's certainly seen better than this, or at least as good as this. And he had, but when he looks at a big picture on the wall, or he looks at a big piece of pottery, he's asking himself, how is that earning the WACC? That's what these EVA people do. They see invested capital and they say, this has to earn at least the WACC. All right. And where this orientation comes from is this thing called the capital charge. And what you do is for every dollar of invested capital, investors require that you earn the WACC on it. Okay, so let's go back here. So investors see $12 of their capital invested in this company. For the use of that capital, they'll be charging 10% times the beginning cap. Okay, and so your economic ROI is still the same. It's still the economic income divided by the beginning cap. So it's the economic income divided by the beginning cap. Okay, and if you don't mind, let's insert a couple of rows here. Because in chapter 12, this wasn't the purpose, but I'm trying to relate this to what we'll be doing in chapter 19, probably a week from today. All right, so let's do our ROI. Let's do our economic income. Our EVA. Okay. And in this case, if you follow this format, EVA, EVB, that's a good one. EVA equals econ income. Well, my typing is going to get an A today, won't it? Econ income less capital charge. All right, so let's try it. Our economic income minus the capital charge. So you see, somebody trained in the ways of EVA, they know that every asset, every dollar of assets that goes in place, there's going to be a capital charge against their income. I mean, not their income, but against the company's income. Okay. So the idea here is that you're not so fast to be spending money unless you know darn well that it will earn at least the WACC. But, oh, look at this. It caught me. Oh, well. Anyway, NPV kind of tells you the same story. If you want a positive NPV project, you have to earn at least R, don't you? Or greater than R. You know, let's flop this back to where it was. I'm sorry. Okay, let's put this one back at 100. I cannot tell you how many files I have where I play to them like that and I forget to change them back. And then I go to look at them later and I go, where did this come from? Anyway. So yeah, so these people see that, you know, if I don't earn at least the WACC, I am losing value in my company. And I think the idea of promoting EVA is that you see this, it's more obvious than it is with a single number. This happens every year. You have to do this every year. Every year you have to have a margin between your ROI and your WACC to create value. Well, let's continue this project. Evaluation. So we're going to do ending is 8, and then the beginning cap is the previous year's ending cap. Okay, here we go. We have one more cash flow left. Let's discount it back at the cost of capital. If you want to type in 1.1, no problem. Just say 44 divided by 1.1. You can do that. Okay, economic depreciation. How much value did we lose? In fact, these are copyable across here. Actually, all of them are. Okay, and then once you have, we got to go here a little bit. Once you have this done, you can copy this one across. All right. So here's what your authors had in mind for this problem for us to see. I mean, what's the object of doing this? Okay, what I'd like you to do, I took this format basically from what it was in your book, and I'd like you to change it for me if you would. So I'm going to take this ending cap, and I'm just going to move it aside and put it right here if I could. And then I'm going to move up this book depreciation, move it up 1. Okay, then I'll put the ending cap back. See what I did? I just swapped places between the book depreciation and the ending cap. Now, the reason being is that the book depreciation is not economically based. It's basically an arbitrary schedule which is designed to account for the loss in value of your capital assets. All right. So we could use straight line. We could find accelerated method. We could, you know, whatever the company uses in its tax accounting. It can choose, you know, one method for tax accounting and one method for reporting. So, like I say, it's not based on economic theory. Okay, so the reason I like to change these is because I start out knowing the book depreciation. I don't know the ending cap. So why don't we put them in the right order? And that's not what your book did, but I think it's a better idea. So I've calculated economic depreciation. I'm so sorry. Book depreciation at $4. So we can lock that if we like. Okay, the ending cap follows suit. We are going to subtract the book depreciation from the beginning cap. Okay, we get the ending cap. So book income. Book income is pretty much the same calculation as economic income. It's just the cash flow minus the book depreciation instead of the economic depreciation. So we say here equals cash flow minus the book depreciation. We get $1.20. And our book ROI is calculated exactly as you would the economic ROI, except that you use book income instead of economic income. and the cash flow. So let's try it. It equals $1.20 in book income. I'm sorry, beginning capital, forgive me, divided by the beginning capital. And so, do you see this? These are the same. All right, so let's keep firing here. We know that the ending cap for the previous year is the beginning cap for the current year. All right, and the book depreciation, we could actually copy, well, we'll do the whole thing here in a minute. All right, so our ending cap, and these we could just copy. You see, now once you have this beginning-ending relationship set up, now you can copy this all the way across. So we don't need to do this one at a time. All right. So let's copy this across one more. And you notice economic ROI equals book ROI. Okay. And what we have just discovered, whether we knew it or not, okay, so econ ROI equals book ROI if and only if economic depreciation equals book depreciation. Excuse me. So what we'll be doing, either you might start it next class period or the following Tuesday, we will be, one of the methods, this is called economic value added. Our method will be called the economic profit model. And we will be following a procedure very similar to what the EVA people do. And that was another argument against, not against, but our argument is that there's nothing new in the EVA. And some people argue that because I'm pretty sure that the economic profit model was in place before, excuse me, before the Stearns Stewart group started promoting their EVA. And there's all kinds of studies, some which say that companies that adopted EVA are outperforming their peers and outperforming what they were doing before they adopted EVA. And there are other studies that say that it didn't make any difference. So it's kind of interesting. I guess it depends on what side you're on. So if you're on the side that promotes EVA, then you probably side with the studies that show that it creates value. But anyway, so this section is fairly close to what we'll do when we start evaluating companies instead of just projects. It'll be called the economic profit model, and it has some of these elements. It has the capital charge. We will have the beginning cap. We will have the let's see, how do we work that? It's going to be, okay, so we needed we're gonna have the economic, we're gonna have economic income, and then we'll have the capital charge, and then we will have a excuse me, an economic profit. So a zero EVA is equivalent to a zero economic profit. But what we'll find is you have the company that has cash flows and profits for into the future, and therefore their EVAs or their economic profits will be positive for the upcoming years. At least in examples that will be working, they will do that. All right, so that's all I have for now. If you'd like to, you might want to read ahead and examine the Word file, and you'll see what we'll be covering. It's somewhat similar to what we did here, the EVA, but your Chapter 19 assignment asks that you use what's called the free cash flow model. And so we will begin on Thursday with the free cash flow model. Now, another argument which would say that there's nothing to be gained from this EVA or the economic profit is that the economic profit model and EVA models are algebraically equivalent. So if you use the economic profit model, you should get precisely the same number or the value of the company that you would get if you had used the free cash flow model. So they should come out the same. Free cash flow and economic profit models give you the same result, and we will work an example in which that actually occurs. And then I will have one problem from Chapter 19 will be your assignment from there, and then I have an additional Excel sheet that I would like you to work for your assignment too. All right, because yeah, this economic profit model is not in Chapter 19. So we'll have to learn that entirely from my document. All right, so good luck. I'll see you Thursday. We'll start with the free cash flow model on Thursday. I will answer any questions we might have remaining in the few minutes that we have left. Listen to that.